Welcome to qiphyedu. Today we'll be looking at economics paper 12, October-November 2021. Alright, let's start. First question, it says line XX is the production possibility curve of a worker picking peas and beans in a 10-hour working day. And what could cause the worker's PPC to shift to the line YY? So you can see that for line YY, the quantity of peas picked per day for the production possibility curve, it's actually the quantity is higher for peas and lower for beans. So what could have caused this shift? Let's take a look at the options that we have. A, it says a decrease in working hours to 8 per day and a machine that increases the workers' pea picking productivity. This may be a possible answer, so I'm just going to take it first, but let's look at the few other options. B, it says a machine that increases the workers' pea picking productivity only. Now, if let's say they only add one machine that increases the workers' pea productivity, the quantity of beans picked per day will not shift from X to Y. It will remain the same because that's the amount that can be picked, possible quantity that can be picked for that particular day. So it will not shift from X to Y because there's already a machine that will help the workers' pea picking productivity. So it will increase the quantity of peas picked from, say, X amount to whatever amount, but be higher. But it won't decrease the quantity of beans picked per day, so B is wrong. C, it says a new work schedule where the workers spend 6 hours per day picking peas and only 4 hours picking beans. Now, even though the workers spend 6 hours per day picking peas, that doesn't exactly mean that the worker would then pick a higher amount, a higher quantity of peas, because for the PPC, it supposedly, let's say this is for picking peas and beans in a 10-hour working day, you allocated 6 hours to just picking peas and then only 4 hours to pick beans. It's possible, but it's not really a suitable reason, because even though you give 6 hours per day for the worker to pick the peas, doesn't exactly mean that the quantity will increase. It also depends on how many peas are available for that day, for example. And even though you decrease like the beans picking hours to only 4 hours, doesn't exactly mean that the quantity of beans picked per day would be exactly from X amount to Y amount. So this could be a possible answer, but it's not really the best answer here. Like if you compare to question A, selection A that we have. So let's look at D. D says a reduction in working hours to 8 per day only. If let's say there's a reduction in working hours to 8 per day, it won't be like an increase in quantity of peas picked and then a decrease in beans picked. So D is not correct. So we compare A and C. A makes more sense because a decrease in working hours to 8 per day would decrease the quantity of beans picked, and then the machine that increases the workers' pea picking productivity does increase the quantity of peas picked. Assuming that everything else is the same. So ceteris paribus. So then with the increase in productivity due to the machine, the quantity of peas picked can then be increased. So C doesn't look like the best answer. The best answer will be A. All right. So question 2, what is the function of money? So it's from the previous syllabus. So the function of money is it acts as a medium of exchange. So answer is D. The top 3 selections are all characteristics. Question 3, what is classified as a public good by economists? Public good is basically a good that is non-excludable and non-rival, and it's funded by the government through tax payments. So A, it says flood defenses, which is correct. B, it says government funded hospitals. This is a very good. Government run national parks is also very good. D, the internet. The internet is not really a public good, because if you want to access it, you need to buy the data package. So the thing that can be classified as a public good is flood defenses. Question 4, which statement about the factors of production is correct? So A, it says the factor capital includes shares and deposit accounts and banks, which is not correct. B, it says the factor labor includes human-made resources, which is not correct. Labor is basically the employees, the human itself. C, it says the factor land includes forests and undiscarded copper, which is correct. D, it says the factor enterprise takes risk and is rewarded with interest, which is wrong. It's rewarded with profits. So capital is the machinery itself, the capital goods that we have. So it's not the shares and deposits. And then B, labor is not human resources, it's the human itself. So answer is C. Question 5. Which supply curve shows that the price elasticity of supply of the good is always equal to 1? So the PE, the curve must always start from 0 in order for the PE S to be equal to 1, and it must be the straight line. So A, it says a straight line that intersects the horizontal axis, which is not correct. B, it says a straight line that intersects the vertical axis, which is not correct. And C, it says a straight line that passes through the origin, which is correct. And D, it says a straight line that is vertical, which is not correct. So answer is C. Question 6. What could cause a shift in the supply curve of good X and a movement along its supply curve? A shift in the supply curve could be due to a few reasons, but let's look at one by one. A, it says a change in demand for good X. A change in demand will result in a movement. An increase in the price of a substitute good would not result, it would result in a movement, but a change in demand for good X would also result in a movement, so A is not correct. B says a decrease in factor productivity, which is a shift. The imposition of tax will result in a shift as well, not a movement, so B is not correct. C says an increase in the price of a complementary good. Okay. And then this will result in a shift. And then an increase in factor productivity would also result in a shift, so C is not correct. But D says an increase in the wage rates in the industry, which will result in a shift. And then put along the supply curve, a change in demand. Correct. Answer is D. Okay, so for question 7, the market for mobile phones is initially in equilibrium at X. The government then imposes a sales tax, and what is the government's total tax revenue? So originally the quantity is at Q1 and S, so it's at this point. Then it shifted to K, which is Q2 and T. So we need to calculate it by calculating the distance between the price before tax and the price after tax, which is Km. And then the area, which is Rm, from 0 to quantity 2. So it's, we look at which one will be the answer here. So A, it says JKX, which is not correct, because JKX would be something like this. And then B, it says TKLS, which is not correct, because it's only this portion. And then the next one will be TKMR, which is this entire thing, so this is C. Then D says UJXS, which is this entire thing, which is not correct. So answer is C. Question 8, what is an example of the rationing function of the price mechanism? So rationing is basically when you have limited amount of the particular good, then some people will be excluded. So A, it says when the price of product is falling, firms will allocate less resources. This is price signaling, not correct. B, when the price of product is falling, the government can set an effective minimum price. This is government intervention, or so it's not the rationing function. C, it says when the price of product is rising, firms will expand production of product to make profits. This is price signaling. And D, it says when the price of product is rising, some consumers will no longer be able to buy. This is price rationing. Okay, so for question 9, it says in 2016, car drivers bought more fuel because the price of oil from which it was made had fallen, and which diagram represents this change in the market for fuel. So the price of oil which it was made had fallen, so that means that the oil itself is a raw material and the price has decreased, so the cost of production decreases, so supply curve will shift to the right. So anything that doesn't have a shift in the supply curve will be wrong, so A, B, C is wrong. So answer is D. Question 10, the diagram shows the demand and supply curves for bread in a developed economy. Bread is a substitute for pasta and rice. And what will cause the demand curve for bread to shift from D1 to D2 in an economy? So, reason why there will be a shift would be because, as you can see here, it says that bread is a substitute for pasta and rice. An increase in demand could be from a few reasons. The main one would be that the other substitutes are more expensive. So A, it says a rise in the price of pasta and rice, which is correct. Let's look at the 3 other options. B, it says a decrease in the real income of consumers, which is not correct. If there's a decrease, then the demand will not increase. They didn't mention that it's a normal good or is it a inferior good. C, it says a recession and rising unemployment will result in a decrease in demand, so it's not correct. D, it says subsidy given the producers, not correct. C is Amy. Question 11, the table shows the quantity demanded of 3 goods when the price of good X changes, and which relationship between X, Y, and Z can be deduced from the table. So when it's at $5, the quantity of X demanded is 100, quantity of Y demanded is 60, and the quantity of Z demanded is 20. So every time when there's a as you can see here, for quantity X demanded, every time when there's a decrease in price, the quantity increases. And then for Y, the quantity decreases. For quantity Z, it increases. So Y is a substitute. Y is a substitute. So the AB is wrong. So it has to be C or D. And then Y, X, and Z, they are increasing at the same time. So they have to be complements. So answer is C. Question 12, the diagram shows three supply curves, and what can be concluded about the PES of these curves? All these curves have PES equals to 1 because they all start from 0. So A says as price rises, the price elasticity of supply S2 will increase, which is wrong. B says at any price, the price elasticity of supply of S1 will be less than that of S3, which is wrong. And C says at any price, the price elasticity of supply for S2 will be higher than that of S3, which is wrong. So answer is D, the price elasticity of supply of each curve is constant. Right? Question 13, the diagram shows the market for smartphones in India. Rising incomes in India have seen a demand for this normal good shift from D1 to D2, and which area now represents consumer surplus and which area now represents producer surplus. So now the demand for this good shift from D1 to D2, so D2 is at point M. So the consumer surplus would be FMH. This part with the consumer surplus, so CD is wrong. And then producer surplus would be HMK, so answer is A. Question 14, a nationalized industry is privatized. Assuming there is no change in the output of the industry in the short run, what are the direct effects of this change? So, a nationalized industry is privatized, which means that the size of the public sector has to decrease because the private industries, the main goal for them is to maximize their profits. So they have to remove some people out of the market. They have to remove some people out of their firms, their company. So the size of public sector would decrease, so CD is wrong. And then it says proportion of industry output entering the market. So the proportion of industry output entering the market, because now the output, because it says there is no change in the output of the industry in the short run, so the proportion of industry output entering the market will be no change. So answer is B. Question 15, what is a distinguishing feature of a progressive income tax? So a progressive income tax would be when the higher income the people from higher income groups, they earn the tax that they pay would be much higher in proportion compared to people from the lower income groups. So let's see which one is the closest one. A says high earners pay a higher proportion of their income in tax than low earners, which is correct. Let's look at three other options here. B says high earners pay a lower proportion of their income, wrong. C says high earners pay the same proportion of their income in tax as low earners, which is wrong. And D says low earners pay more tax than high earners. This is regressive, so it's not correct. So answer is A. Question 16, why might the government nationalize a private firm? The reason why a private firm would be nationalized would be to increase merit good provision, allow the goods to be at a cheaper price. So A says to gain greater efficiency, which is wrong because if you nationalize private firm, then there's only one, technically there should only be one company. B says to increase merit good provision, which is correct. C says to increase choices, nope. D says to raise more tax revenue, which is not correct. So answer is B. Question 17, the diagram shows a firm's supply of and demand for apples. If a minimum price is increased from P1 to P2, what will happen to the amount of apples sold? So you can see that at P1, the quantity demanded is Q1 and the quantity supply is Q3. But after the increase in price, the quantity demanded will be Q2 and then the quantity supply will be Q4. So let's look at the four options. A says it will decrease from Q1 to Q2, which is correct. B says it will decrease from Q4, Q1 to Q2, Q3, which is not correct. C says it will increase from Q3 to Q4, which is not correct. That's for the supply. D says it will increase from Q3, Q2 to Q4, Q1, which is not correct. So answer is A. Question 18, in an attempt to reduce crime, a government introduced a subsidy on the production of burglar alarms, but sales rise very little. And which possible characteristics of the good will lead to this outcome? So for question 18, when the government introduced a subsidy and the effect is very low, this means that the price elasticity demand for that good is very low. At the same time, the price elasticity supply for that good is also very low. So both of them have to be low. So answer is D. When the government introduced a subsidy on a particular item and then the sales rise really, really well, this is when your PED and the PS are elastic. So if let's say you introduce a subsidy and then there's no effect on sales, this has to be the fact that the item itself is already inelastic. The demand for itself is already inelastic to begin with, and at the same time the supply is also inelastic because the producers are unable to respond to the change in price quickly. They're not very responsive to changes in price to increase the changes of the percentage change in the quantity supply. So answer as with D. And question 19, compared with Pakistan, Germany has a higher output of pharmaceuticals per unit of resources used, and what could explain this? So this has to do with absolute advantage, so the answer is B. Question 20, which statement about inflation is correct? Inflation would result in an increase in the general price levels. So A, it says inflation will lead to a rise in exports, which is not correct because of the higher prices. B, it says inflation will lead to a rise in real incomes, which is not correct. This is real income. It will not lead to a rise in real income. C, it says inflation will lead to a rise in the cost of living, which is correct. And D, it says inflation will lead to a rise in the purchasing power of money. It will decrease the purchasing power of money, so this is not correct. So answer is C. Question 21, why is it that a country's balance of payments must always balance? A country's balance of payments must always be balanced because of the fact that our current account must be balanced by both the other two accounts. You realize that for this particular question, it actually covers capital and financial accounts, which is not in the current AS syllabus. This is in the previous syllabus, but let's just do it anyways. A, says exchange rate changes will correct any deficit or surplus, which is not correct. The exchange rate could be floating, it could be managed float, or it could be fixed. So doesn't mean that the exchange rate will correct any deficit or surplus. It's not theoretically possible. B, it says one country's deficit is balanced by another country's surplus, which is not correct. The balance of payments is for that particular country only. And C, it says the current account is balanced by the capital and financial accounts, which is correct. D, says the government must act to correct any disagreement. This is a normative statement, so answer is not B, answer is C. Question 22. Which argument for protection will be most relevant if the government of country X decided to exercise voluntary export restraint in its trade with country Y? So let's look at the four options. A, says voluntary export restraint would achieve an immediate correction for X balance of trade deficit. Balance of trade deficit is basically your volume of imports more than your volume of exports. So definitely no, because it will get worse with a decrease in exports. And B, says voluntary export restraint will cause the level of GDP to increase in country X, which is not correct, because if let's say there's no exports, there's no AD. When there's a decrease in AD, when there's a decrease in AD, there'll be a decrease in real output, so a decrease in GDP. So no. C, says voluntary export restraint will help to negotiate improved trading conditions, which is correct, because maybe country Y is in a state of economic they're in an economic downturn, so they probably need to reduce the exports to the country. So yes, it does help to negotiate improved trading conditions. D, says voluntary export restraint will help to reduce the level of unemployment, which is not correct, because if you decrease your exports, it will decrease your AD, and then unemployment will increase because of less jobs. Answer is C. Question 23, the average price of a country's exports increased by 5% and the average price of its imports increased by 10%, which means that the terms of trade have worsened. Not anything to do with balance of trade is not correct here, because balance of trade is for volume of goods, so AB is wrong. It says terms of trade have improved, the terms of trade have worsened, the terms of trade have worsened, so answer is D. Question 24, there's an increase in indirect taxes, and what will be the impact on demand pull inflation or cost push inflation? So when there's an increase in indirect taxes, your cost push inflation would increase, so it will rise, and then for demand pull inflation, it falls because less people will be purchasing the goods. So answer is B. Fall in demand pull inflation and rise in cost push inflation. Question 25, the table shows the number of biscuits and cakes that can be produced by 4 workers in an hour. So who has the greatest comparative advantage in producing biscuits? So Laura can produce 6 biscuits and 3 cakes. Mo can produce 10 biscuits and 10 cakes. And then Nathan can produce 13 and 12, and then Omar can produce 8 and 16. Looking at numbers alone, if you just take Laura's numbers, for example, let's say she produces 2 biscuits, she can produce 1 cake. And then for Mo, that will be 10 and 10. And then Nathan would be 13, 12. And then for Omar, it'll be 816, which means that if it's Omar, then he's better off producing cakes. And then for Nathan, he has a comparative advantage in producing biscuits, but it's not as significant as Laura. The same goes for Mo. He or she can produce both biscuits and cakes at the same quantity. So the one that has the greatest comparative advantage is Laura. So answer is A. And then for question 26, which condition is necessary for a country's balance of payments on its current account to improve if it reduces its exchange rate? So for a country's balance of payments on its current account to improve, the sum of price elasticity for demands for imports and exports must be greater than 1. So A, it says both the price elasticity or supply for its imports and exports must be elastic. Not really the case. We are looking at the Marshall-Lerner condition, so both sum of PED x plus M must be more than 1. So B, it says the importing country will buy all the excess supply of its trading partner to clear the market, which is not correct. C is correct because it says sums of price elasticity of the domestic demand for imports and the foreign demand for exports must be greater than 1. D, it says the trading partners need to agree on the maximum prices to be charged for imports and exports. This one would be an agreement which doesn't necessarily improve the current account or the balance of payments. So it's not correct, so answer is C. Question 27, the diagram shows the effect of the US imposing a tariff on the import of steel in 2018. And which statement about the impact of the tariff is correct? So you can see that before the tariff, the quantity demanded would be at X, and then after the tariff, the quantity demanded will be at Y. Quantity supply would originally be at U, and then after the tariff is at T. So A, it says consumer surplus falls from P1 TO, which is already wrong because that's the producer surplus. B, it says domestic output increases from OQ1 to OQ3, which is not correct because OQ3 is the quantity demanded, so no. Imports fall from Q1, Q4 to Q2, Q3, which is correct because from Q1 to Q4 that would be your total imports because of this line. It says quantity supplied, the difference between the quantity supply for the domestic producers and also the domestic demand. That will cover up, the foreign producers will then cover up the amount that is missing from the domestic supply. And then D says the tax revenue rates on imports is P1 YWP, which is not correct, right? So because P1 YWP will be this entire area, so this is not the tax revenue collected. So answer is C. And then for question 28, in 2012, the Indian government stated that it aimed to reduce its budget deficit to 5.1% of the GDP, and which policy is most likely to help this aim in the short run. So in the short run, to reduce the budget deficit, then that means that it will be short-run policies that will be your fiscal monetary policy. So A, it says a decrease in import tariffs, which is not correct. B, it says a decrease in the rate of interest, which is not correct, because if you decrease the rate of interest, it will result in more AD. More AD meaning there's more budget deficit. C, it says an increase in the sale of state-owned assets, which is correct. And D, it says an increase in government pension payments, which is not correct, because it will result in more expenditure. C will result in more revenue, because you're selling your state-owned assets to other people. So your government will earn. I'll say C. Question 29. What would make a policy of raising interest rates less likely to be effective in reducing inflation? So so if you raise interest rates, it would be effective at reducing inflation because it's monetary policy. It will result in the AD curve to shift to the left. But then let's look at 4 options to see which one is less likely to be effective. A, it says aggregate supply is increasing faster than aggregate demand, which nope, is not the answer. B, it says consumers expect prices to rise even faster in the future. This will result in the AD remaining the same, so it will not shift to the left because they think that the price will rise even faster in the future, so might as well just purchase now. C, it says consumer spending is largely paid for on credit, which is not correct. And then D, it says interest rates are still higher abroad, which doesn't have anything to do with domestic inflation. So answer is B. Question 30. Country X is an open economy with a floating exchange rate. It changes to a fixed exchange rate. And which combination of policy changes will be most effective in reducing inflation? So you want the taxes to be very, very high in order to reduce inflation. So you can see that for A, B, C, D, it's either a choice between high direct taxes or indirect taxes for fiscal policy. Direct taxes are actually more effective than indirect taxes because you are taking tax, you are gaining tax revenue directly from the employees. So higher direct taxes would be better to reduce inflation. It will be more effective at actually shifting the AD curve to the left. So ACD is wrong, and then your new fixed exchange rate must be above purchasing power parity, which means that it must be above the purchasing power that consumers have in order to reduce their chances of actually purchasing more goods. If it's below purchasing power parity, their purchasing power will be high. So it has to be above the purchasing power parity. So answer is A. Alright, so this is the end of this paper. I hope you find this video helpful. Do share out to other people who may make this video. And I hope to see you again in the next video, which will be again about another economics pass paper. Till then, this is qiphyedu.